Hey guys, this is Mr. Roxy coming at you live from Palm Beach in Florida. I figured today was going to be another start of a week where there's not a lot going on, and probably the old adage is no news is good news. Only to wake up to futures deep in the red and the stock market just crashing after it opened early on Monday, which is today. It is January the 24th. It's Monday, and all around us the world is ending. So I thought, you know what, I better check in and say hello to everyone and see if we can make heads or tails of what is going on here today. Did you know that today, by the way, is one of Google's most researched, one of Google's most searched terms is stock market crash, or why is the stock market crashing and such like. So it just shows you the impact of the market on a massive global search engine like Google, where everybody wants to know why is the market crashing. So I don't recall us having a discussion about moving the market into a correction territory on January the 24th. I mean, you guys didn't warn me at all, but here we are, right? So for what it's worth, a correction is when the market pulls back approximately 10%, and we have about 2 or 3 of those every year. So this is not necessarily something extraordinary or something new. It does happen, and of course it feels bad. So here we go with 1 Maserati, 2 Maseratis. Let's see how we're doing. Well, the Dow right now is only down 743 points. Just an hour ago, so today, right now it's about 1:30, so about an hour ago or so, the Dow was down more than 1,000 points. So you could argue, if you are bullish and optimistic, you could say, gee, that's a nice little turnaround for the Dow. The S&P, of course, is down a lot, but the index that has been taking most of the punishment and hurt is the NASDAQ, which of course is tech-heavy index. I don't own a lot of tech stocks, as you know by now. I have most of my stocks in energy and financials. And then I have a range of other stocks, which includes things like REITs and industrial conglomerates and stuff like that. I'm not really in tech, but I do have some SPY, the ETF SPY. So of course, that one is down quite a bit as well. Overall, I think I was up about 40% or so. So after the pullback, I'm probably up about 5 or 10%. I'm not sure. I don't really look at the stock prices of things like that on a day-to-day basis. I just hold them. And sometimes from time to time, I add to them a little bit. Crude oil down 2.3% based on nothing. So let's see what's going on in the marketplace. Stocks sink ahead of a packed week of earnings and the Fed meeting. So of course, the Fed is meeting tomorrow and Wednesday. And by Wednesday, we will either crash some more, or otherwise we'll go up a bit, depending on how much money they promise to print. Now, a lot of noise in the marketplace is about the Fed increasing rates, and everybody's talking about 25 bips or even 50 bips, and heaven forbid they should go 50 basis points higher. You know what, in the greater scheme of things, that doesn't really matter. That's just media reporting. I think everybody sort of expects the Fed to increase rates. Nobody really knows when, and whether they increase by 25 or 50 basis points, it's really pretty much baked into the market already. Tesla stock is down 6%, right? So this gives you an idea. You know, one of the things that I always do when I look at my own portfolio is to say, if all my stocks are down and the market is up, then I chose some bad stocks, in theory anyway. But if everything is down, then we just ride the Big Dipper together. What else is in the news? Bitcoin price drops continues as risk-off ripples across the market. The best stocks to own when interest rates rise. Well, I can tell you the best stocks to own when interest rates rise, and depending on where your head's at, the best stocks to own just period are value stocks. Buy companies that have manageable debt, that own assets and produce stuff, and you'll be okay. So by saying that, I'm eliminating some of the reasons why, some of the tech stocks. Some of the reasons why I don't own tech stocks is because tech stocks very frequently own nothing. They're just sort of advertising companies that have very little assets, and many of them still carry a whole lot of debt in addition. But I like stocks that have assets, you know. So I'm an old traditional value investor. I like I like to look at a balance sheet and see that if you look at all the assets and you take away all the liabilities, there's a nice chunk of owner's equity on the other side of the ledger. Is the market crashing? No. Here's what's happening to stocks, bonds, as the Fed aims to end days of easy money, analysts say. So what I did was I clicked on this link here, and it's actually quite amusing, right? So is the market crashing? No. Here's what's happening to stock bonds as the Fed aims to end the days of easy money. It's the same headline I just read, right? So here's the article, guys. Americans are wondering what's amiss with Wall Street after steep declines in stocks and a surge in bond yields in recent weeks. Now, pay very careful attention here, because here is how to think about it. Seriously, it's not like my internet went down and then it came back up again. This actually just displayed in this particular manner. And then when I clicked on the little bubble below that said continue reading, it actually opened up the article. So if you really want to know what's amiss with Wall Street after the steep declines in stocks and the surge in bond yields in recent weeks, here's how to think about it. A big blank. Well, anyway, what is in the article? Let's take a quick look here. What's happening? Okay, this is the actual article that just happened to come up as a blank on Yahoo, which I thought was really, really funny. Come on, guys, you got to have a little bit of a sense of humor when everything around you is crashing, right? One Maserati, two Maseratis. Equity benchmarks are being substantially recalibrated from lofty heights as the economy heads into a new monetary policy regime in the battle against the pandemic. I haven't heard anything about the pandemic for quite a while. I think over the last few weeks or so, we've pretty much been hearing that the Omicron variant is pretty much like getting a cold. So I haven't really heard too much about the pandemic lately. Surging inflation. Well, there's a topic that is first and foremost on many people's minds. On Twitter, for instance, lots and lots of people are posting pictures of empty shelves in supermarkets and increased prices, not just for gas at the pump when they fill up their cars with petrol, but also increased prices on anything from bread to chicken or whatever the case might be. Just this morning, I saw a lady who had posted on Twitter. She said a few weeks ago, chicken thighs were $3 a pound. I'm not sure where she lives. I think she's Canadian. And she said this morning I went and purchased some more and it was $8 a pound. Well, that is a very easy indicator of hyperinflation when something rises from $3 a pound to $8 a pound in the space of just a couple of weeks. But here's where it gets really interesting, right? So on top of all that, doubts about parts of the economy. All right, so now we've covered a couple of things already, right? We talked briefly here about the pandemic, just above my blue highlight here, and surging inflation. So the markets are crashing as a result of that. A new monetary policy regime. We know the Fed might increase rates. Now we add in some additional things here, events outside of the country, such as China-US relations. That's causing the market to crash. Or the Russian-Ukraine conflict. That is causing the market to crash. Or maybe it's the Middle East unrest. Might be causing the market to crash. And these are all contributing to a bearish or pessimistic tone for investors. Now, guys, I have said this before. I speak to many investors on a regular basis. I actually don't know anyone who's been selling. In fact, there are people, including myself, who has actually been nibbling and buying little bits of adding to my existing positions as the market crashes and tumbles down. There are a couple of things that I've added to over the past week or so as the market sort of entered this correction territory. And they're quite diversified. There are some energy stocks. They are also added to some of the uranium microcap stocks in my speculative portfolio. And then I also added to some of the larger positions I have, like energy transfer. I purchased some more Sibanye Stillwater. It's a gold mine. I want to buy some more Petrobras, but that one hasn't actually pulled back enough for me to add to my existing position. Ironically, last week when energy was down, Petrobras was green, and today Petrobras was only down 2 or 3%. might pick up some more if it pulls back suddenly, 6, 7, 10% or something in one day, and then I might get myself some more. The NASDAQ composite entered correction last Wednesday already, ringing up a fall of at least 10% from its recent November 19th peak. November 19th seems so long ago. The NASDAQ last encountered a correction on March the 8th, 2021. On Friday, the NASDAQ stood over 14% below its November peak and was inching towards a so-called bear market. So a correction is 10%, and if the losses extend beyond 10%, then you're entering the sort of bear market territory. So by definition, simply based on the numbers, that's kind of what it looks like. A bear market is usually described by market technicians as a decline of at least 20% from a recent peak. So we've already crossed the 10% line, which was a correction. Now we're heading towards 20%. Will we get there? Nobody knows. Nobody on earth knows. The only guy who possibly knows the answer to everything is Jim Cramer. So other than that, nobody knows. These three stocks are safe bets in the event of a market crash. Now, I'm not particularly interested in these three stocks, but I'm going to mention them briefly anyway because they come up in the article, right? This is an article from today on Motley Fool at 10:20 a.m., so just a couple of hours ago. Key points. He's talking about Realty Income, AG&C, and Duke Energy. So here's the thing, guys. So we're at the start of the video, I said most of my investments are in energy and financials. And then I have some other equity investments like industrial conglomerates, REITs, and so on. So one of my REITs is AG&C. Realty Income is basically the same as AG&C. I have been adding to AG&C as well. AG&C is a REIT that I've been in for a long, long time. And with reinvested dividends, it has been very rewarding for me because the ANG REIT currently pays a dividend rate of, well, I don't know about today's stock price, but it's probably paying a dividend of about 7% or so. At one stage, as the AG&C dropped during the COVID pandemic in March, April 2010, that dividend went up to way over 10%. And then the third one, the author mentions here, so Brent, is Duke Energy. So it's not so much about Duke Energy, it's just energy. Energy will perform well in any market environment. Right now, energy, regardless of what the EIA says in terms of build up in inventory or basic projections based on supply and demand, all that kind of stuff. If you're in energy, you're in a good place, and I wouldn't touch those. In fact, there are literally three things that you can do when the market kind of crashes as it currently is crashing. You can nibble a little bit and buy a little bit more. You can sell and lose money, which is probably the most horrible decision you can make because the only time you actually lose money is if you sell at a loss. So those are two potential strategies, right? You can buy more and basically average out your cost higher or lower, depending on where you're coming from. Or otherwise, you can say, I'm going to sell and take a loss. Or otherwise, what you can do is you can say, I am doing nothing. And doing nothing is a strategy as well. If I was going to buy anything, almost without exception today, it would be energy. I mean, like I told you at the beginning of the video, I mentioned that I wanted to add to some Petrobras, but it hasn't pulled back enough yet. What should you do with your investments? So the key points here, also from Motley Fool, also today, 7:30 a.m. today, Eastern time. The stock market recently experienced one of its worst weeks in nearly 2 years. While it can be tempting to pull your money out of the market, there is a better strategy. It's easier than you may think to keep your money safe. The Motley Fool issues are rare. All in, buy alert. What happens when there's a correction? Smart people buy smart companies, especially value investors, right? We look for bargains, and then we add to some of these positions. And over the longer term, you do quite okay. The thing that you just don't want to do is just panic and exit. You don't want to look at the market as it declines on days like today or weeks like the past week or so and say, all right, I'm just going to, take my toys and go home. I'm not playing anymore. But that's a sure way to lose money. So right now, I'm not here to advise you, right? So there are smart people who do that. So what I do want to say is, of the three choices that you have, which is sell, which is a bad choice, buy a little bit more, which is a very bold and high risk strategy. And the last one is do nothing, which is probably the most logical strategy. It's like, just be patient and wait. You'll be okay. I don't think we're entering into a bear market territory overall as a whole. And if you really look at the news, and guys, you don't have to take my word for it. I mean, just do that Google search that says, why is the market crashing? All the analysts and all the news media people are basically blaming all kinds of stuff. They're saying the rest of the earnings season is expected to be weaker than expected. The Fed is going to increase rates by 50 beeps instead of 25 basis points. And there's tension in the Ukraine and Russia, and US-China relationships are not very good. And there's conflict in Saudi Arabia. And if you, in other words, what I'm saying is, if you do the research, you'll find the answer is all over the map. Whereas if you are viewing the market from the point of view of saying we're going into a bear market and everything is bad and we're going to crash, and then we're all going to lose all our money, there has to be a compelling, fundamental, underlying reason, which today, as I'm making this video, I don't see. So I'm not trying to tell you everything is great. I'm just trying to tell you not to panic, and we'll be okay. On that note, this is Rudy for Best Investor signing off. I'll talk to you guys soon. Bye-bye.